Hey everybody, it's Chip again. Just wanted to get back with you on some updates regarding the housing market and the economy as I see it. So big things have happened since the last time we've done a video. So half a point increase, the Feds increased the rates by half a point, which was expected on their last increase of the year this year. The consensus is, and even the Fed has admitted during their statements, that the Fed will continue to increase interest rates throughout probably at least halfway through 2023. So kind of probably expect half point to quarter point increases from this point forward, 3 or 4 more times. That's my speculation. I think that's my expectation. And so what does that do to mortgage rates? Well, it does adversely affect mortgage rates, and it does tend to push mortgage rates higher. However, I will say that, that's not that main determining factor for mortgage rates. And as we've seen over the last month or so, mortgage rates have actually lowered and tampered down some to more, reasonable rates in the 6s, even in 15-year mortgages into the high 5s again. And so, at one point in time we were well into the 7 to 8% range for mortgage rates, which we may hit again at some point in time. But the speculation is the rates will continue to muddle along kind of where they are now, hanging around in the 6s and maybe high 5s for the next 6 to 8 months, which isn't terrible. Those are not bad rates, historically speaking. And so we've got to take that into perspective. They're historically higher and bad rates compared to what we've had over the last almost decade. But from a historic perspective, going all the way back to, when things were being measured, a 6% interest rate is a pretty darn good rate. So that's the perspective. Now, from a mortgage perspective, if you're a mortgage producer or an originator or a financial institution that does a lot of mortgage lending, it's a little rough right now because not as many people are buying homes because interest rates are a little bit higher and they're a little sticker shock still. Inflation's high, so everything's costing more. So your affordability factor is even worse than it was last year when a lot of people were buying, but at high prices. Now you got high prices and high interest rates. So things have slowed down dramatically, over 35% lower year over year from existing home sales perspective. So what does that do to the mortgage market? Well, it dries it up because nobody's going to refinance their mortgage where they have a 3% interest rate and refinance for a 6 or 6.5% interest rate. It just makes no financial sense. If you own a home and you have a 2.5, 3, 3.5, 4% interest rate and you don't have to move, why would you move? Because you're going to end up with a mortgage on your new home at between 6 and 7% versus the lower rate you have now, and your monthly payments really reflect that. So that's the halt factor of the real estate industry and the mortgage loan origination industry right now. It is pretty anemic, and it's also a time of year because we're in December, or it's Christmas time here. So from a seasonal perspective and from an economic and rate-driven perspective, the housing market's pretty slow. And not only is it slow with new buyers coming on, but it's very slow with new listings coming on because, again, people don't want to sell if they don't have to, if they have a low rate. Why exchange that for another house in a very high rate and a higher priced home? So that will continue well into 2023. I think 2023 will continue to be a slog fest for real estate agents and for any real estate related industry, whether you're a builder, a mortgage loan originator, or a real estate agent, or even investor. There will be opportunities for investors, and we've talked about that in the past, but you have to look for them very carefully because sellers, if not distressed, are still in the mindset that they can get pretty top dollar for their house right now, which is why houses are sitting longer than they have in quite some time, because people are kind of overpricing or being a little too aggressive still listing their homes for sale, and the buyers just aren't there right now to pay extra for the house. And so All that being said, 2023 is going to be a slugfest in the real estate industry, and that does affect the whole economy within the United States, because the real estate industry is a huge portion of that. It does affect jobs, and like I've always said, jobs are key. Jobs. If people are working and have money, they will spend it. And we've actually seen that, because the jobs numbers have come back pretty strong over the last all year. Even though we have a slowing economy, the jobs still are hanging on, and wages are still increasing some. And so we've seen that in consumer sentiment, because we got the consumer confidence and consumer sentiment numbers out earlier this month, and they were very strong. I mean, consumers are spending money, and they're not letting this economy and their mindset around the economy slow them down in that regard. Now, whether that will continue throughout 2023, it's a wait and see game. But if jobs are had and people are getting paid, my recommendation is, or my prediction is, that consumer sentiment will continue to be okay, because they have money coming in that they can let go out. Now, will they temper their spending? Yes, most likely, because things are just more expensive. We're also hitting a seasonal bump with the Christmas holiday. However, if jobs hang on, the economy from a spending perspective will hang on as well, and that will also help the housing market rebound. Maybe even faster than I anticipated, because I've told you in previous videos that 2024 into 2025 especially is going to look pretty golden in the real estate market. We're going to hit we're going to go up again. It's going to be an upward slope of opportunity for those in the real estate profession, and for home buyers and sellers. And so, until then, what does it look like? And that's the big mystery. And my thought process is, it's more of the same of what we have right now. Slower sales, slower people, not as many people listing their homes, not as many people buying homes. And we're going to continue to see that trend until the end of 2023, when I think the economy is going to slow enough to where the Fed really pushes back on the interest rate increases, and actually may even reverse and start lowering interest rates to help invigorate the economy again. And so jobs are key. I mean, I always say this, and I've just said it again. Jobs are key. If layoffs start occurring in big numbers, and new jobs are not hiring in big numbers like they are now, that's a big difference maker in terms of how quickly interest rates stop going up and how quickly they start going back down. So if jobs hang on and consumer sentiment and spending hangs on, rates go up, exponentially throughout 2023. If at some point in time in the next year jobs start being hurt more than they are now, then the Fed will, I think, pivot and stop increasing rates, of course, but I think actually start decreasing them to help invigorate spending and get the economy back on track, which will then push us into a very favorable 2024 and then 25. We'll see what happens, but that's my prediction. Until next time, I'll talk to you later.